This week on the Business Owners Corner, I'd like to talk for a few minutes about using SBA loans to purchase commercial real estate. The reason we're talking about that this week is we work in our financial planning firm with business owners predominantly, and a lot of business owners come to the conclusion that their business has to operate somewhere. Maybe they're paying rent to a landlord. Maybe they want to buy the building that the business occupies, which makes a lot of sense. It's the same decision as renting versus buying in your personal life. Buying a house is not the right decision for everybody. For some people, it makes a lot more sense to rent, but it's a pretty good option. And if you feel like you're shelling out money to a landlord just to live, you might be better off purchasing the house and building some equity in it. Same goes for the building that your business operates in, whether that be an office building or a warehouse or a retail shop. It doesn't matter. You might have the opportunity to purchase one of these things. SBA financing is a really popular way to finance one of those acquisitions. And today I want to talk through the mechanics of that for just a few minutes. Structurally, how we typically want to structure this thing is if you buy a building, let's set aside the financing for a moment and just say you have enough cash to buy the building outright. What you want to do is buy it as an individual or maybe with your spouse. Perhaps you might want to set up an LLC to do this, depending on what state you reside in, and then have the business lease space from that other entity. Because doing so, you have a separation of assets, you have some asset protection there, and it's a very helpful way. And plus, when the time comes for you to exit the business, maybe you turn the keys over to somebody else, maybe you sell it, well, you can keep the building and retain them as a tenant, which is a very nice income stream in retirement. So the question comes down to financing. How are we going to pay for one of these things? What people often get confused about SBA financing is that they think it comes time to buy a building and we're going to reach out to the SBA and ask for money. That's not quite how it works. SBA financing is attractive in a lot of circumstances, but in a lot of circumstances, I think borrowers are surprised to hear that it may not even be the best option for them. SBA financing is simply federally sponsored programs where the federal government, the Small Business Association, will back your mortgage or your debt. But you still obtain the money by going directly to an ordinary lender. So if you have a relationship with a local banker, maybe that you talk to, you have your company bank accounts there, or you have lines of credit or credit cards or something like that for your business, that's probably where I would go first. Approach them and just ask them what they can do for you. Oftentimes they'll say that we can use SBA loans, but we have a lot more boxes to check when we use SBA loans. They're less profitable to the bank. And because of that, they can actually offer you better terms for you through a more traditional financing mechanism. The key is you just approach the banker and tell them what you'd like to do, tell them a little bit about the building, how much cash and down payment you might want to put toward it, and then see what they can do for you. The SBA program, if that is indeed the best route for you, is typically going to be what's called a 7A SBA loan. There are two predominant types of SBA loans: the 504 program, which is more frequently used to buy equipment and capital goods, and the 7A program. The 7A program you can use to buy equipment, but most often it's for real estate purchases. The deal is you still get the money from the bank. You go through all their underwriting and you fill out all the forms at the bank. And then as part of that paperwork, the bank then submits that to the Small Business Association for backing. And if you default on the mortgage, the SBA comes in and subsidizes the bank that issued the mortgage. Now, the terms on these things are a little bit different. To qualify for one of the SBA loans, and when I say that the SBA backs the mortgage, they're not backing 100% of it, they're backing 75 to 85% of it, depending on the size of the loan. Anything less than $150,000, any loan less than $150,000, the SBA backs 85% of it. Anything over 150, they back 75% of it. Not that matters to you as the borrower, that matters to the bank. So the deal is, to qualify for SBA financing, if you're purchasing a building, it has to be at least 51% owner occupied. If you're building a new building, if it's a new construction, it has to be at least 60% owner occupied. You can borrow up to $5 million to do this. Generally, when you borrow money to buy or build real estate, it amortizes over a 25-year period, which is a little bit different than your ordinary mortgage on a house. These days, the rates are a little higher than they have been historically. Interest rates are a lot higher today than they were a few years ago. And SBA loans today are somewhere between 10 and 13% per year. So they're a very helpful option to people who don't qualify for other more traditional forms of financing. But in general, this concept of buying the building that your business exists in comes with a little additional risk, little additional headache. Now you're a landlord, you have to maintain the building and deal with all that, which is a huge project and a topic for another day. But hey, the business has to pay rent somewhere. It may as well be to yourself because it can be a great wealth builder long term. So if you're considering this, these days what I'm hearing is that you have to have at least 10% down if you're considering purchasing a building. But if it's your business that occupies a little bit more than half, you have an opportunity to buy the building and you have some cash laying around, it could be a really, really great long-term wealth building opportunity. The key is just approach your banker, see what route might make the most sense. If you don't have 10% down, it's probably not going to be a good fit.